program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Great you can join us again here at AusBiz. Let's take a look at what happened overnight. Global equities beginning the week negatively following 5 straight sessions of gains. This ahead of key economic data that could determine if the US Federal Reserve cuts interest rates this month. US stocks were weighed down by rising treasury yields as data showed persistent weakness in the manufacturing sector due to the tariff impost. US chip design software maker Synopsys surged after Nvidia took a $2 billion stake in the designer as part of a broader engineering and design tie-up aiming to infuse the AI computing technology into more industries. Shares of EV maker Tesla slipped as monthly registrations, which are regarded as a proxy for sales, slumped almost 60% in France from a year ago. And shares of vaccine makers Moderna and Novavax fell as the US FDA Chief Medical and Scientific Officer told agency staffers that COVID vaccinations probably contributed to the deaths of at least 10 children who died of heart inflammation. Shares of BHP and Rio rose, tracking the high price of copper, and shares of cryptocurrency and blockchain-related companies fell as Bitcoin extended its losses after its steepest monthly decline since the 2021 crypto crash. Well, US manufacturing contracted for the 9th straight month in November, with factories facing slumping orders and higher prices for inputs as the drag from import tariffs persisted. The Institute for Supply Management's manufacturing index easing half a point to 48.2, with the measure remaining below 50, which does indicate contraction. US consumers, meanwhile, expected to spend more than $14 billion on Cyber Monday, according to Adobe Analytics, after a strong Black Friday weekend that saw wealthy consumers spend freely and lower income shoppers hunting for bargains. Americans are expected to spend around 6% more online than last year's Cyber Monday, traditionally the country's biggest online shopping day, and the culmination of the 4-day shopping frenzy that began after Thanksgiving. US online spending on Black Friday hit a record $11.8 billion and $23.6 billion for the weekend overall. That's up 9% from last year, according to Adobe, which tracks 1 trillion visits that shoppers make to online retail websites. US Treasuries have fallen, pressured by weakness in Japanese and European government bonds, following comments from Bank of Japan Governor Ueda, who signalled that conditions were aligning for a possible rate hike. The US 2-year Treasury yield rose to 3.54%, the 10-year lifting to 4.09%. The Aussie 3-year government bond yield rising to 3.96%, the 10-year is at 4.6%. And the US dollar index little change, the Aussie trading at 65.4 US cents. Oil prices have risen following drone attacks by Ukraine, the closure of Venezuelan airspace by the United States, and OPEC's decision to leave output levels unchanged for the first quarter of 2026. Brent crude futures up 1% to $63 a barrel. Copper's up more than 0.5%. Iron ore rising just over 1% to 106 US a tonne. And gold has risen to a 6-week high, supported by growing expectations of US rate cuts and a weaker US dollar, while silver struck a record high ahead of key US economic data. Spot gold at around $4,235 an ounce. And Bitcoin has tumbled below 87,000, having lost around a third of its value in the past 8 weeks. Well, let's get across markets with a focus on the US. Steve Sosnick is joining us from Interactive Brokers. Steve, welcome back. So,
great to see you, Andrew.
Might begin with what we heard from the BOJ governor there, Ueda, flagging the possibility of a December rate hike. So this had implications across the globe, particularly lifting yields and putting some downward pressure on stocks. What are you seeing there in terms of that effect?
Well, good morning. I think the trend in Japan has been, sort of the opposite of what we've seen in the US, where everybody's focused on rate cuts. There, of course, they see the need for rate hikes. And we saw their 2-year note go to the highest level in 17 years. It's actually fascinating. I plotted the likelihood of a Japanese rate hike versus the likelihood for a U.S. rate cut. And over the past 2 weeks, they've actually moved kind of in lockstep. It's pretty interesting to see that. This is actually from the Forecast X market, which is a prediction market actually owned by Interactive Brokers. And you can see there that we went from about a 20% expectation for no hike to about 76% when I did this morning our time. And over the same period of time, the move for a rate cut in the U.S. from, let's say, the 21st of November through today went from about, call it 30% to about 80 some odd percent over that same period of time. It's kind of uncanny, actually, when you think about it. And I think that these moves have been moving around markets. And interestingly, the repercussions from today's hike probability, which went, let's say, from 60 to 75 or 80, really took their toll on fixed income, as you noted. And they really precipitated the drop in crypto because if you look at the chart, the overnight trade, when I say overnight trading, was during your regular session. It was basically just, he spoke and crypto fell out of bed. And it's really, showing you how tied risk assets are to the perceptions about the carry trade.
Are markets also perhaps unnerved by the likelihood of changes to the makeup of the Fed, given we have heard from President Trump saying he's made his decision of who the next Fed chair is going to be? Markets betting that will be Kevin Hassett. What does that tell you, and perhaps what a trade is concerned about in terms of Fed independence?
It's actually interesting to me. I think that I would have expected the yield curve to steepen a little bit more on that news because quite frankly, he sort of falls into the camp pretty much as would any of the potential nominees from President Trump toward picking. If you have to pick a side, it would be picking a side toward the stable employment part of the dual mandate and worrying less about the inflationary aspects of that mandate, and therefore you might expect to see the yield curve steepen based both on expectations that they would be a bit more aggressive at cutting rates and a bit more lax at combating inflationary expectations, which influence the shape of the yield curve and thus the relationship between long and short-term rates. We saw that a bit today. It's hard to unpack, what was, whether we kind of ignored the news because it was quiet holiday trading last week, whether there was a little bit of a reaction to it today, or whether the bonds were reacting to UEDA, or whether they were reacting to supply concerns on the corporate side. Merck, went to market with about $8 billion in bonds. It's probably a little bit of all of the above. But that's really the thing I'm watching for is, will you see a reaction? Will the bond vigilantes ultimately be okay with this if and when the news is finalized? Prediction markets are very much leaning toward Hassett at this point. It seems like a foregone conclusion. And he was on television, yesterday and wasn't taking a victory lap. He was classy enough not to do that, but did not really dissuade the idea that he thought this was going to be him.
Meanwhile, we're getting more data out of the States there. Steve, the ISM manufacturing survey, weaker than expected. Is this the effect of tariffs that we're seeing at the moment? Probably.
I think it's a little bit of each. I think there's just sort of, there's a bit of a, I'm not going to say a full malaise, but certainly there are concerns underneath the economic landscape. And, with the one thing to keep in mind, ISM is a private number, so we never had the data lag there. They just kept doing the numbers because they were unaffected by the government shutdown. So yeah, we're seeing that slip. 50 is, anytime you're below 50, because it's a diffusion index, means that things are going in the wrong direction, and actually they were shrinking a little faster. And also, as I saw on your chart there, the prices paid ticked up a little bit there. So prices paid is running in the 50s. Manufacturing itself is running in the 40s, and the headline sort of combines to 48.2. It's hard. Again, it's tricky to say what's tariffs, because I think that tariff the tariff policy being what it was is creating more uncertainty, and I think that's putting the damper on the economic activity right now. You could see there that little tick up there on the far right on the prices paid section, and inventory's ticking up a little bit. None of that adds up to anything all that good. If you go look through each of the subcategories, none of them are really moving in the right direction, and that does lead to, it's a sign of malaise. Although, you can, as you reported about Black Friday and Cyber Monday, consumers keep spending. I know my wife did her part.
Yeah, well, similarly with my family as well, Steve. So, look, just finally, do you feel as though the equity market is still set up for a Santa rally, at least? I mean, that's what market participants are betting on.
Well, remember, the Santa Claus rally is pretty specific. That's literally the period between Christmas and New Year's. So that that's another one of those where really anything could happen. Because if you thought last week was a light week, it's an even lighter week. I know it's an even lighter week for you guys because it's the middle of summer vacation and you have Boxing Day and we don't. Things of that nature. But in general, I think the feeling, and I've been is about positive seasonality in December. I've been asked several questions about it today, over the course of the day about positive seasonality. It is one of the better months, although we have had some scary Decembers. I think of 2018, where we pretty much plunged into a bear market during September. Seasonality, I used the term earlier today with some other people that it was seasonality is a fickle friend. It works, but there's nothing magical about it. It's more of it's more other statistics on your side. I think the psychology is still there. I think we saw buy the dip come in because stocks certainly did better than other asset classes today. I think that's, again, a testament to the resilient psychology among equity investors, at least when it comes to the biggest stocks in the index. And so, it's still, you still don't want to be fighting this tape because the psychology remains very strong.
Steve, have a great week. Thanks for joining us from Interactive Brokers. That's Steve Sosnick from Interactive Brokers. All right, let's quickly turn to our local market. We are expecting a higher open, only just, and we're going to get across all that news in just a moment. Join us for the open.
This program is brought to you by LGT Wealth Management. Welcome to the next chapter in trusted advice, where global strength and deep local relationships shape wealth that lasts for generations. LGT Wealth Management, lgtwm.com.au.